What are the tax consequences of losing a spouse? That's what I'm thinking about. So as we're in the fourth quarter of the year, a lot of our work revolves around tax planning for our clients. And unfortunately this year we've had some clients and family members of clients who have lost their spouses. And it has me thinking about the change that happens from a tax standpoint when that occurs. And what happens with it is that in the year when somebody loses a spouse, that year they get to file married filing jointly, the same as if their spouse were still alive. But then after that, in the following years, they need to file as unmarried, so separate or as a single taxpayer in most cases. If there's young kids involved, then a person can file head of household, which is a little closer to married filing jointly. But for most of the people, all the people we're talking about here anyway, they're looking at filing as a single taxpayer going forward. And when you're a single taxpayer, the standard deductions are lower and the tax brackets basically are higher. You get to higher levels faster. And so I put together a conglomeration. Here's an example of grabbing some things from some actual client tax returns and putting them into our tax planning software. And take a look here at the top when you're, income of $131,000, right, with the standard deduction that's in there, and you get to come to a taxable income or tax due of about $12,000 here, right? And when we take that same income and look at that as a single tax filer here, same income, taxes go up to almost $20,000, right? So, I mean, more than a 50% increase, maybe close to a 75% increase in taxes by going from married filing jointly to single, right? And, you know, on the tax bracket, as a married filing jointly with that income solidly in the 22% tax bracket, as a single person, you're way up, you're into the 24%, and again, pretty solidly in the 24% bracket. So that's something to be aware of. People can tend to forget that. So what do we do about that? And let me make just one comment too, is that, you know, this is using the exact same income. There's probably going to be some differences, right? Where maybe, I mean, no Social Security, or Social Security gets cut down. I mean, it's not a dollar for dollar. So maybe instead of a 50% increase, we're talking a 20% or a 25% increase, but it's still going to be different and higher in the future for a person as a single taxpayer. So at this time of the year, when we're talking with all of our clients about should we do Roth conversions and intentionally pay some taxes at today's tax rate so we're not paying higher taxes in the future, you know, usually we're thinking about giving money to kids, giving money to grandkids, inheritance type things. This is a type of situation where if you or somebody you know finds themselves in a position where they've lost a spouse, maybe this is the year where they should be considering before the end of the year here, doing some Roth conversions, accelerating some income, right? Like paying taxes at today's rates because tomorrow's rates are going to be higher. And similarly on the other side, if there's deductions, I'm going to make a donation to charity or something, maybe we look to push that into the next year when we know that tax rates are going to be higher. So that's what I'm thinking about today. And as always, interested in what you're thinking about. If you're watching this on YouTube, put a comment in the comment box or shoot me an email directly. And as always, thanks for watching.